Hey everyone, welcome back to Corporate Decoder. Today we're diving into ZoomInfo's latest quarterly report, and let's just say they're definitely shaking things up in the cloud-based platform world, though not always in the ways you might expect. It's a bit like watching a high-stakes chess match, but with spreadsheets. Before we jump into the juicy details, if you're all about understanding the real story behind companies' financial moves, make sure you're subscribed. And hey, we've got a growing community over on our Discord servers all about dissecting these reports, so join the conversation down in the description. Scroll ZoomInfo Technologies Inc. Consolidated Balance Sheet Scroll. So let's get straight to the core of it, the financial statements. Looking at their balance sheets as of June 30, 2025, ZoomInfo is showing total assets around $6.45 billion. That's a pretty substantial number. Now let's talk about accounts receivable, which is basically money that customers owe them. As of June 30, 2025, this was $92 million, down from 2046 million at the end of the previous year. This drop could be a good sign, meaning they're collecting money faster, or it could mean they've sold less or their customers are paying up quicker. Okay, let's pivot to what really brings in the money revenue. For the 3 months ending June 30, 2025, their revenue was $306.7 million. That's up about 5% from the same time last year when it was $291.5 million. For the first half of the year, revenue hit $612.4 million, a slight increase from $601.6 million in the first half of 2024. This growth, while not explosive, seems steady. Now, what does it cost them to provide these services? Their cost of service was $40.1 million for the quarter, up from $36.30 million last year. This increase likely ties into their investments in AI and customer onboarding, as they mentioned. Think of it as spending more to keep their high-tech engine running smoothly. This brings us to their gross profit, which is what's left after they pay for the direct costs of their services. For the quarter, it was $257.2 million, giving them a gross margin of 84%. That's a very healthy margin, meaning they keep a large chunk of every dollar they earn after the direct costs are covered. This high margin is a good indicator of their pricing power and efficiency in delivering their core product. Let's look at how much they spent to get those sales and market their platform. Sales and marketing expenses were $106.3 million for the quarter. That's a 6% increase from last year. It seems they're willing to spend to bring in new customers and grow their business, which makes sense for a growth-focused tech company. ZoomInfo is also investing in the future, with $44.6 million spent on research and development this quarter. This is actually a slight decrease from last year, but they're still putting significant resources into improving their platform and creating new features. This is where things get really interesting. General and administrative expenses were a massive 64% lower this quarter compared to last year, coming in at $47.3 million versus $111.47 million versus $111.5 and adding one charges. So while G&A is still a significant cost, it looks like they've managed to cut down on some of those one-time big hits. And all these costs and revenues play out in their operating income. For the quarter, they reported an operating income of $53.7 million. That's a massive jump from a loss of $20 million in the same quarter last year. This turnaround is largely due to those avoided lease-related charges and that improved revenue. Finally, the bottom line, net income for the quarter was $24 million. This is a huge improvement from a net loss of $24.4 million in the same quarter last year. They successfully turned a loss into a profit, which is always a great sign. Digging into those expenses, we see restructuring costs. For the quarter, these were $5.1 million, a big drop from $50 million last year. This reflects changes they made to organize the company better, like reducing their workforce, which they mentioned happened in June. Something that pops up quite a bit is the tax receivable agreement remeasurement. For this quarter, they actually gained $14.6 million from this. Essentially, it's a complex financial maneuver related to tax benefits they expect to get, and the value of those benefits changed. It's a bit of accounting wizardry that impacts their other income line. Let's talk about how they pay their people beyond just salary. Equity-based compensation, which is giving employees stock or options, was $29.7 million this quarter. It's less than last year, which makes sense as they've had some workforce adjustments. ZoomInfo is also buying back its own stock. In the quarter, they spent a considerable $146.3 million on this. This can signal confidence from management in the company's value, or it can be a way to boost earnings per share by reducing the number of shares out there. Looking at their stock as of late July 2025, there were over 318 million shares outstanding. The number of shares has been decreasing through these buybacks, so that's a developing trend. Now, a crucial metric for subscription businesses is net revenue retention. This tells you how much revenue they're keeping from their existing customers, including upgrades and minus any churn. Their rate was 89% as of June 2025, which is good though slightly down from 85% the previous year. This means for every higher is better, but this is still a solid number suggesting customers are sticking around and even adding more value. They also provide adjusted operating income margin, which is a way to look at their core business performance without some of those one-off expenses. This stands at 34% for the quarter, which is a healthy increase from 28% last year. This shows that their actual operations are becoming more profitable. Let's talk debt. Their total net leverage ratio, which is basically how much debt they have compared to their earnings before interest, taxes, depreciation, and amortization, stands at 2.5 times. This means they have about 2.5 years worth of their adjusted earnings in debt. That's a moderate level, not extremely concerning, but something to keep an eye on, especially as they use more of that revolving credit facility. So what's the story here? ZoomInfo is showing resilience. They've managed to increase revenue and, most importantly, turn a loss into a solid profit. Their gross margins are excellent, indicating a strong core business. However, they are clearly investing heavily in their platform, particularly with AI, which is driving up some costs like hosting. The significant reduction in general and administrative expenses is a major positive, largely due to cutting down on those big infrequent charges like lease impairments. The company is actively managing its capital structure, buying back stock, and drawing on its revolvers, which indicates a certain level of financial flexibility. While their debt levels are moderate, they're managing them well with strong earnings. The retention rates are solid, and the move towards more profitable operations is a clear strategic win. Overall, ZoomInfo seems to be executing its strategy effectively, navigating a competitive market and a changing economic landscape. They're investing to stay ahead, especially with AI, and crucially, they're demonstrating an ability to translate that investment into profitability. Alright, that's our breakdown of ZoomInfo's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.